This gap is based on the 4-hour chart. Okay, let me go up one more slide, okay, so we can get our calibrations. 109, big figure, that's this high here, and then 108.50 in that vicinity is this gap. That's this, the 109 big figure, and the 108.50 level, that's in here. When we see it drop down into a 1-hour chart, we have this inefficiency, yes. It trades up to it and reprices to the high. This is what you expect. You want to see it trade there and stop dead in its tracks. That is institutional order flow. Does it react to it and go lower? Yes. Then the market attacks what? What's resting below here? Sell side. The market does, in fact, go below that. Then it created in this run below that low, that 108.60 to 108.40 level, which is the 4-hour fair value gap. This is the high of the 4-hour fair value gap level. This is the low of the fair value gap on the 4-hour. This little inefficiency right here is denoting simply that candle's low and then this candle's high with that one big down close candle in the middle. Look how price has moved back and forth in here. You see that? And then on this one big candle down, you only had the separation between the candle's low prior to it and the candle after its high. That's what this little red shaded rectangle is. So on the 4-hour chart, this high of the fair value gap and this low of that 4-hour fair value gap, it does not need to reprice up to that high like it did here on this one. Why? Because you have this efficient delivery and balancing of price action. It's delivered to the downside. The next candle we open, trade up, and then trade back down. Right there by itself, that's balance for me. Then it throws you one more confirmation. We open, trade up one more time to it, and then rejects hard, leaving at this candle's close right here, that small little inefficiency right there. When you see me talk about in commentary while I'm taking a live trade and I'm typing out, when I draw out the fair value gaps, I say, I want to see this remain unfilled. When I'm typing in, or if I talk about it, I want to see this fair value gap stay open and unfilled. It's ideal or optimal for it to not fill in. I'm not just simply looking at the chart I'm trading. I'm looking at all the lower time frames too, and I'm reading price action just like this. So imagine for a moment that 4-hour chart, let's go back up one slide. This inefficiency right here, if I'm going short in that, I am telling myself that it should not go up there and touch the top of that fair value gap. It should stay open, unfilled. But let's just say that this was a 5-minute chart, not a 4-hour. And then we drop down into this time frame, 1 hour. So this would be like a 1-minute chart, or maybe it's a 30-second chart, or a 15-second chart, or a 5-second chart. On a lower time frame, less than 5 minutes, and it could be on the second chart. If I see in between those two ranges, the low and the high of the fair value gap, I anticipate trading up into and wanting to be short. I see this inefficiency here. I do not need or anticipate or expect price to go up to the high of it because it's already done this. 1, 2, 3. And then the small little inefficiency here. That's why it stops dead in its tracks in a consequent encroachment, which is half of that gap here, and then stops at the low. And then you see it fail, leaving this portion open. That's real institutional order flow. This is how I know when gaps are not going to completely fill. Because on a lower time frame chart that I'm watching, and I have one specific chart, or not chart, but I have one monitor that I have that I call a matrix. Okay, it's an intraday matrix where it allows me to look at 5, 4, 3, 2, 1 minute candles, and then I toggle and I can go down into a 45-second chart, a 30-second chart, a 15-second chart, a 5-second chart, 1-second chart. So I'm looking for these types of signatures in every inefficiency I'm watching on price. The relationships that on the lower time frame, it's showing you delivery. You're going to be reading price action. And if you have all this back and forth movement, that's layering. You would see a wall of price action here and another wall before you get to the old order flow. So it's already moved back and forth 3 specific hours of back and forth price action near the high end of that 4-hour fair value gap. So there's no necessity for price to go up above, really, this candle's low. And it doesn't even get to it there. It stops midpoint of that little small inefficiency right there. And then does one more time here, fails, slides. And then we work off of another order block in here and holding price at bay. And we broke down. A small little gap in here. We had that run up. And we have sell side building right here. All right, here's the 15-minute chart of the euro dollar. And now we're getting down to the brass tacks of intraday price action. And we have the 2022 model right here. But you have a gap. Relative equal highs. What's resting above these highs? Buy stops. The market rallies up, runs through, engages the buy side, and trades into the inefficiency. Why doesn't it trade all the way up and touch the top of that? Well, what's this candle doing over here? It's one single pass and then one single pass. That's a balanced price range. That's why you don't get all the way up in there. So there's 2 different forms of knowing how I don't anticipate a full closure or repricing to a fair value gap high or low respectively. If it creates these balanced price ranges where it's one single pass and then one single pass in between those 2 candles, the high and low, the highest of the gap, which would be this here, and the lowest would be down here. So that's your that's your balanced price range between these two ranges. So we have this run up in the buy stops, we hit it, and then we price lower. So isn't this low taken out right there? Isn't that the 2022 model? We have buy stops taken here. And then we have a shift in market structure. Does it have a fair value gap? Yep. Order block, extend that forward. Trades up into it, breaks lower. Notice it doesn't completely close in the top of that fair value gap. Why? The order block stops it. There's a change in the state of delivery there. Then we have price break aggressively lower again, moving below this low. We have another inefficiency. Buy stops were taken here. Here's another model 2022. Fair value gap, trades up into it. The low of that candle. Now watch. This is for the order block freaks. Okay. These two up close candles are consecutive. That's a bearish order block. The low of that candle, extend that through. What is it in overlapping? Consequent encroachment of that gap, midpoint. It's real close proximity to that. So if we have a coupling or a confluence of these PD arrays, half of this gap, that low of those two consecutive up close candles, that is your order block. That's your change in the state of delivery. Why is that the change in the state of delivery? Because it's also in close proximity to the halfway point or consequent encroachment of this inefficiency or sell side imbalance, buy side inefficiency. Half of that is about right there, which is right at just about that low of that candle. Price stops dead in its tracks right at that order block where the change in state of delivery it occurs. Then it prices lower and takes the sell side out here. Let's go into a deeper dive with this right there. Just know that these two consecutive up close candles, that's my bearish order block. The change in the state of delivery is at that low. We're going to look at this candle right here closer on a lower time frame. Here's that same price delivery that was on the 15-minute chart, now on a 5-minute chart. 15-minute order block. It's parent. This is subordinate. This is a 5-minute chart. It's going to be subordinate to the 15-minute candlestick chart. So the narrative is derived on the 15-minute. Then you look for signatures on the 5-minute to align with that. So this is that low of those two up close candles on the 15-minute chart. I'm extending it forward. Can you see visually how that's essentially half of this range right there? That's why it goes right up there and stops. That's why this level here stays open. Doesn't need to go up there. Why? Because the order block is the change in the state of delivery. It stops right there. So that means all this price run up above these buy stops here, it goes above to engage those buy stops. Yes. But does it go up to some random level? How do you know how far it's going to go when it's running stops? I'm doing this. This is technical science. I'm reading everything in the price action. This movement lower from this high down to that low, that's your price swing. That's your dealing range. And then you have to split that up. Equilibrium. So we went into what? A short-term premium. To some random level? No. A 15-minute bearish order block. That is the consequent encroachment of this fair value gap. Why would smart money want that? Because they're going to sell short here. What are they going to do with that? They're going to offset distribute their shorts by accumulating the sell stops below that low. And that's what you have right there. So smart money sells short. All through here, they're selling short. Selling, up to that point, they stop. They can't assume any more because this is where they're being told, this is it, that's the threshold. Then, as price goes down, they're starting to distribute. They're selling short, but they're buying back as price breaks down close candles. Right there, rallies back up. And then right below that candle here, once it goes through that, they're covering more. And then covering right below the low where the sell side is. That's real institutional order flow.